Singapore's central bank expects inflation to get worse before it gets better. It projects core inflation to peak between 4 and 4.5% in the current quarter, before easing to between 3.5 and 4% towards the end of the year. Core inflation excludes private transport and accommodation costs. Heidi Ng tells us more.
The Monetary Authority of Singapore says inflation will continue to come down next year. That's assuming that supply chain frictions ease and global commodity prices stabilize. But it warns that it will still remain well above the 1.5% rate it has averaged since 2000.
If there are fresh shocks to global energy and food supplies arising from the ongoing conflict in Ukraine, or a significant overheating of the domestic labour market, inflation may end up being higher and more persistent.
MES says its moves to allow the Singapore dollar to appreciate is starting to rein in inflation. The central bank has tightened monetary policy 4 times since last October. Since then, the Singapore dollar has appreciated by almost 4% against the currencies of its major trading partners. This has helped to reduce export demand, but has also made imports cheaper. However, the tighter financial conditions and squeeze in real incomes is expected to slow Singapore's economic growth.
In Singapore, economic growth is expected to moderate further in 2023 in tandem with the slowdown in our major trading partners. The extent of the growth moderation will depend in part on how the scenarios for the global economy will pan out. As of now, we expect neither a recession nor a stagflation in Singapore next year.
But one analyst warns that further tightening by MES may not work as well.
Even if there's any move in coming October, the move will be marginal. Because number one, we are near the peak of inflation. Number two, there is also increasingly higher risk on growth. If inflation is more domestically driven, then the Sing dollar exchange rate policy may not have a direct impact on taming inflation.
In its annual report, the central bank also says it recorded a net loss of $7.4 billion for the financial year ending 31st March 2022. The loss was from lower investment gains, higher interest expenses, and a negative currency translation due to a stronger Sing dollar. This is the first time MES has slipped into the red in nearly a decade. As a result, it did not contribute to Singapore's consolidated fund and did not return any profits to the government.